Hi guys, welcome back. Intel just reported the third quarter financial results with revenue growing 5% year over year and earnings per share exceeding the guidance by a whopping 61 cents. And they have raised the full year guidance for earnings per share and gross margins. And yet, the share price tanked by 11.6%. So let's dive right in and find out what's going on. The first thing that spooked the investors was a lower notebook volume. Intel reported it is down by 26% compared to last quarter. And while the ASP has increased for this quarter, it is down by 12% compared to 2020. I'm not sure why Intel chose to present the numbers in percentage terms where it looks exaggerated. In actual terms, the impact on the business segment is only 2% or $183 million. To put it in perspective, the revenue is only down marginally. So, what else is going on here? Intel also provided revenue guidance at $19.2 billion for the next quarter, and the gross margin is expected at 51.4%. This is the second point that spooked the investors. It is a sizable drop from the heydays of 60% margins and above in 2017 and 2018. It looks like AMD's rise is putting a lot of pressure on Intel's margins. The market is expecting a higher margin closer to 60%. The operating income came in at $5.2 billion and the net income is $6.8 billion. Strangely, the net income is higher than the operating income. The reason for that is this item here, gain on equity investments. So I dug into the earnings report and found that it was due to the sale of McAfee's enterprise business and the dividend they gained from that sale. That is what resulted in the 60% gain in earnings per share for this quarter. Taking away this one-time gain, the earnings per share would have come in at around 111. That is still a good earnings per share. But the way it was reported probably confused the investors and they sold off in a big way. Intel should have been upfront about the gain. The gain from the McAfee sale was not mentioned anywhere in the earnings press release. And the earnings per share outlook is 78 cents for the next quarter. That is another big drop from this quarter's earnings per share. The price drop has pulled down the PE ratio to 9.6. Imagine a market leader in a highly profitable industry trading at 9.6 PE. Let's take a look at the cash flow. The operating cash flow is healthy and came in at $9.9 billion. Capital expenditure is $4 billion. It will grow in the next few quarters as Intel ramps up its two new fabs in Arizona. That still leaves a handsome free cash flow of $5.9 billion. Intel's balance sheet looks strong on the surface, with assets at $168 billion and liabilities at $78 billion. The bulk of their assets are in property, plant, and equipment. This is followed by goodwill at $26 billion. Intel's cash position is very weak at only $7.9 billion. The quick ratio is merely 0.27. Intel will have to take on more debt to finance its operations, and they already have a debt of $35 billion. That is 21% of total assets. With the price dropping heavily, the price to book has also dropped to 2.2, bringing Intel into the value investors range. I published this chart in my previous video. It was trading at $53 then. My analysis was if $53 breaks, it will hit to $44 to $48 range. Here's the updated chart. The price went up a bit to $56 and has dropped heavily on Friday to $49. Here's the weekly chart that shows the next support at $44. Here's the daily chart with the downtrend channel. The price has dropped into the mid channel and it has also fallen through the support at 52. If it does not recover back above the blue channel, it will continue to slide to 44. So, is Intel still a company to watch? Absolutely. It is a market leader but is going through a rough period, and it is likely to last a few more quarters or even a year or two before they recover back to the heyday of high margins. But it is during these periods that presents the opportunity to get into a strong stock. To put things in perspective, the gross and net margins are still strong. PE and price to book are in the value region, but the price is falling. I think things are likely to get worse before it gets better. So it is safer to wait for it to stabilize and recover out of the blue trend channel before buying. The long-term trend is still up with another potential push up with a target of 68. If the buy price is 44, that would give a reward of $24. Stop loss can be set at $40 for a risk of 4. That would give a risk-reward ratio of 6. Hi guys, I need a little bit of focus group feedback here. Could you tell me whether the white charts or black works better? Please leave a comment below. Coming up next is Lamb Research and Netflix. Please consider subscribing if you have found this channel useful. It will help me to bring more videos and trading ideas every week. Thanks for watching and bye for now.